Welcome to Headline Roundup for June 6, 2022. This week, we're going to talk about the global elites of the World Economic Forum are now urging that we eat cactus and seaweed to save the planet. Inflation is now causing 25% of Americans to delay retirement, according to a recent study. You've probably heard of the country song, Should Have Been a Cowboy. We're going to talk today about Should Have Been a Lifeguard. Gas prices continue to reach record highs. And do we now have a confirmation of a recession? So a lot to talk about here. Here's the latest from the World Economic Forum. The World Economic Forum urges people to eat seaweed, algae, and cacti to save the planet. The World Economic Forum technocrats are urging people to ditch meat and other foods deemed to be harmful for the planet and instead consume climate beneficial foods such as seaweed, algae, and cacti. The World Economic Forum made the call as it wrapped up the 2022 meeting of global elitists in Davos, Switzerland. A video summary was posted to Twitter in which the World Economic Forum promoted alternatives to a food system it claimed is responsible for 2/3 of global carbon dioxide emissions. Here is the tweet from the World Economic Forum. It says by 2050, we'll have 10 billion mouths to feed on a finite planet. Tuck into something that could change the world, and there was a link to the video. A starter list published by the organization triumphs algae as being an ideal replacement for meat because it has a carbon negative profile, I should say, and is high in essential fatty acids and high vitamin and antioxidants content. The guide also highlights cacti as containing high amounts of vitamin C and E, carotenoids, fiber, and amino acids, noting that it is already commonly eaten in Mexico. This food crisis is real, and we must find solutions. That's according to the World Trade Organization director. Now, back in December of 2020, the World Economic Forum published 2 articles on its website, which explored how people could be conditioned to get used to the idea of eating weeds, bugs, and drinking sewage water. And yes, that is a fact, in order to reduce carbon dioxide emissions. Amanda Little, earlier this year, Amanda is a Vanderbilt University professor. She argued that everyone in the world needs to start dining on insects and that the European Union's approval of them conferred a form of dignity to their consumption. In February, Bloomberg said Americans should cope with soaring inflation by eating lentils rather than meat. There is a movement in Germany that is being spearheaded by a group of environmental economists. This group is demanding that huge taxes be imposed on meat products. They want beef to be 56% more expensive. Now, Simon Kent made an interesting observation. There's no record of exactly what was served to the 2,500 invited delegates dining at the elite gathering in Davos. And we don't know as to whether or not they followed their own dietary instructions. However, at the Climate Change Summit in Scotland last year, algae and cacti were not on the menu. Instead, there were a lot of animal-based ingredients that, according to Mr. Kent, were at least double the carbon footprint of the average UK meal. So more of do as I say, not as I do. Now, as it relates to retirement, inflation is taking its toll. In fact, a little bit later on here in the Headline Roundup newscast, I'm going to talk to you about where recession is. And I think we've got an indicator that may confirm my suspicion that we've been in recession since the first quarter of this year. This, however, is an interesting report. This was published Tuesday, May 31, the day after Memorial Day, so just under a week ago. It says 25% of Americans are now delaying retirement due to inflation. Americans' finances are being squeezed as inflation pushes up prices on things such as rent, groceries, and gasoline. In fact, from the time I assembled this particular presentation to the time I'm actually recording it, I'm recording it on Friday, June 3. We've actually seen now gas prices in Michigan for regular gasoline reached $5 a gallon. So certainly we're seeing inflation all across the board. This article points to a BMO Real Financial Progress Index, which is a survey that's conducted quarterly. And as of April 25, survey respondents said that 1/4 of them, 25% of them who were planning for retirement, are now deciding to delay their retirement because of disrupted savings from increased prices. So it's very difficult, as we'll talk about more in today's presentation also, to save money if more of your discretionary income is actually going for necessities. 36% of those responding to this survey have reduced their savings, and 21% are putting away less for retirement in order to keep up with growing costs. That's according to this BMO Real Financial Progress Index, this quarterly survey. Now, Paul Dilda, who's head of consumer strategy at BMO Harris Bank, said, "We haven't seen this level of inflation in a very long time, and it's very daunting." Paul added that many people in or near retirement may not have considered this surge in prices in their financial plans. I think that is a given, since it's been more than 40 years since we've experienced significant inflation. So it's thrown off budgets and timelines. People today that are retiring at, say, 65 years old started working at about the tail end of the last inflationary cycle. So this is really a new phenomenon for today's aspiring retirees. Now, not surprisingly, this article states the obvious. Younger Americans have been the most adversely affected. More than 60% of those ages 18 to 34 said they had to pull back savings contributions and save less because necessities were costing more. Now, in addition to grappling with higher prices on nearly all goods and services, Americans are facing a volatile stock market. So far this year, the S&P 500 has shed 12%. We actually have seen the S&P 500 shed almost 20% before seeing the counter trend rally that I did forecast in the June special report. I think as long as the S&P 500 stays below around 4,400, it's my view that this downtrend remains intact. So what we're seeing now, in my view, is a counter trend rally. Mr. Dilda said it's difficult to save, and these times are making it more difficult. And certainly if your 401k and IRA is invested in a stock-based investment and it's shedding value, you've got a double whammy. Your investments are not performing well, and inflation is causing you to spend more of the money you would have saved on gas and groceries. Now, the article does try to point out a silver lining. The good news is that people are actively making changes to their budgets to combat rising prices. However, when you take a look at the fact that credit card debt from February to March doubled, and the savings rate is now about 4%, down from 34% a couple years ago, it tells you people are spending their savings and using their credit cards to cope with inflation. That is a trend that cannot continue. Should have been a lifeguard. This article is really more, I think, interesting than maybe relevant, but it is absolutely amazing how out of hand some municipalities have gotten and some government agencies have gotten when it comes to making promises. Top paid LA Los Angeles lifeguards earned over $500,000 last year. Now, I've talked about this in the past, that many of these lifeguards retire at age 50 with six-figure pensions. This article just confirms it. It says, who knew that LA lifeguards who work in the sun, ocean surf, and golden sands of California could reap such unbelievable financial reward? It's time we put Baywatch on Paywatch. In 2019, we found top paid lifeguards made up to $392,000. Today, it's even more lucrative. Daniel Douglas was the most highly paid and earned $510,283. That's in 2021. He earned $442,000 in 2020. He's the lifeguard captain. So obviously, as the captain, he makes more than anybody else. He out-earned 1,000 of his peers. His salary of $150,000, his perks, benefits, and overtime totaled $510,000 for the year. The second highest paid lifeguard, Fernando Batoy, pulled down $463,000, up from $393,000 last year. Auditors at openthebooks.com found 98 LA lifeguards earned at least $200,000, including benefits last year, and 20 made between $300,000 and $500,000. 37 lifeguards made between $50,000 and almost $250,000 in overtime alone. And that's not it. After 30 years of service, as I just mentioned, LA lifeguards can retire as young as age 55 on 79% of their pay. A pretty good gig, pretty good work if you can get it. Furthermore, we found that most of the top paid lifeguards were men. In fact, only 2 of the top 20 high earners were women. Virginia Roop made $300,000. Lauren Dale made a little over $300,000 as well. Overtime pay is what really drove these earnings up into what you would consider to be compensation for a corporate executive. 37 lifeguards last year made overtime pay between $50,000 and $250,000. Here is pay from 2016 to 2021, and you take a look at the overtime that some of these lifeguards earned. From 2016 to 2021, which is a 6-year time frame, Daniel Douglas earned almost $1 million in overtime. That's a big, big number. Now, as I mentioned, gas prices reach a record high. Where I live, I saw $4.99 a gallon yesterday. That's up a big chunk this week. The average price of a gallon of gasoline a week ago was $4.62 a gallon. It's higher now. And if you compare $4.62 for Memorial Day to Memorial Day last year, it's $1.58 higher. So we've got gas prices that are 50% higher than a year ago. I would attribute that largely to the Federal Reserve's currency creation policy. There are other causes as well. The article pointed out that the cost of gasoline hit a new record high as Memorial Day weekend kicked off the summer driving season. The average price of a gallon of gasoline, $4.62 on Monday, higher today. A year ago on Memorial Day, $3.04. Many observers say the cost has yet to peak and expect only higher prices as summer wears on. I would certainly agree with that. Bob McHugh, who I interviewed on this week's radio program, is a very hardworking technical analyst. He works harder than just about anybody I think I've ever met, publishing a very extensive newsletter on a daily basis, providing his analysis of markets. Oil presently is about $110 a barrel. He thinks it goes to $200. Well, that means the price of gasoline could just about double from here if Dr. McHugh is correct. Now, Gas Buddy has an analyst by the name of Patrick DeHaan. He said that the summer driving season is here. With it, the most expensive gas prices we've ever seen on Memorial Day. He said, we're likely going to make a run to $4.75 in the next couple of weeks, barring any major change. We made it there. Odds of reaching a national $5 a gallon this summer is 65%. I would put it higher than that. Now, the article pointed out that earlier in May, the average cost of gas hit a new record high every day for 2 consecutive weeks. The average cost of a gallon of diesel fuel was $5.52. Again, it's higher than that. This is contributing to food price inflation as well, because diesel powers the semis that truckers drive to transport things. So this inflation cycle is feeding on itself. In 7 states, all but one out west, the average price of a gallon of gasoline is at least $5 a gallon. Illinois is the non-west outlier with the average price on Monday at $5 a gallon. In California, the average price of a gallon of regular gasoline reached $6.15. Many places in California, it's between $7 and $8 a gallon. And there are actually Twitter videos gas pumps, gas station proprietors changing their pump to allow for double-digit gas prices. That is taking place as well. Now, finally, I want to talk about the employment data, because the employment data is often an indicator that tells us that we may be leading into recession. Now, ADP is a big payroll company. This is from Zero Hedge on Thursday, June 2. With various sentiment measures of employment sagging notably, and ISM manufacturing employment dropping into contraction, it was perhaps surprising that analysts expected ADP to show a $300,000 job or 300,000 job gain in May. However, the analysts were wrong, very wrong. Instead of 300,000 job gains, only 128,000 job gains were realized, and they revised April downward. You know, whenever you look at economic data, particularly economic growth, as it relates to are we in a recession? Is the economy growing? Is the economy contracting? You often get the initial estimate, and then that initial estimate is often revised up to 3 times. I expect that when all the revisions are finally in, that we are going to see that we have been in recession since the first quarter of this year. And I expect that that recession is going to be quite deep. Now, this is a chart from Bloomberg. This is the ADP National Employment Report. Now, if you take a look at job creation, you see the vertical bars on the chart, and I'm going to start from the right-hand side of the chart. You see that May has had the lowest job creation numbers going all the way back to May of 2019, pre-pandemic. And you see that that's been in a downward decline. So if you go to December of 2021, we've seen only 1 month that job gains have bumped a bit. That's February. But since then, job creation has been declining significantly. Now, perhaps the most alarming thing about this data to me as you dig in is that small business employment is declining, and small business is really the backbone of the U.S. economy. So a lot of the economic policies that we've pursued over the past couple of years have been very, very hard on small businesses who don't have the capital to weather the storm, and now that is affecting employment. Small businesses, this is the small business report. If you take a look at small business job creation, small businesses have lost 278,000 jobs in the last 4 months. Now, if you go back to the pandemic, if you take a look at March and April of 2020, there were big job losses. However, if you take a look at what's happened, we've got a very disturbing trend over the past 4 months. 3 out of the last 4 months, we've had significant job losses in the small business sector. More so than we really had in 2020 as a result of an economic lockdown. That is an alarming statistic. Small businesses are struggling. That tells you that when small businesses struggle, the economy is struggling as well. And going back to the fact that credit card debt is now doubled just this year, and the savings rate has declined, it tells you that we have some significant economic issues. Now, there's a couple of charts on this page, and the article points out that goods and services job growth slowed dramatically in May. Services sector additions are at their weakest since the COVID lockdowns. The top chart shows you non-farm payrolls net change. The bottom chart shows you a similar statistic. Actually, the top one is private non-farm payrolls net change for goods. The bottom is net change for services. So we have actually stuff on the top chart and doing stuff on the bottom chart. You can see that demand for both goods and services is declining. I believe that's a direct reflection of the inflation that we're seeing. So if you look at the top chart, net goods producing, these would be manufacturing type jobs, they have declined from about almost 150 down to 24. And you see that we've gone from about 600 down to about 100 on services. So this is really, really big shrinkage. And I think that it's reflective of the fact that we are now entering a recession. And of course, it forces you to ask the question, are American households now simply going broke slowly? Is inflation really eating in to the household operating budgets of many Americans? This is a piece written by David Stockman. David Stockman is the former budget director under President Reagan. I do appreciate Mr. Stockman's perspective. He said, we are apparently back in the spend your way to prosperity mode. Last week, Wall Street greeted the strong April PCE number with a spree of dip buying stocks on the dip, if you will. But you have to wonder just how long households can keep reaching into their cookie jars to spend what they're not earning. Great point. Cookie jars have finite levels of assets, not infinite. According to the Commerce Department, the abysmal 4.4% personal savings rate posted for April was the lowest level since August of 2008. And we know what happened next. It's also damn obvious from the chart that the triple whammy of the COVID lockdowns, the stimmy bacchanalia, and the red hot acceleration of global inflation and supply chain breakdowns has sent the standard economic numbers into a tailspin. Get this. He said, after all, when the savings rate goes from an out of this world 34% to a rock bottom 4% in just 24 months, this is not a standard economic cycle. That is certainly the case. Instead, what you have is uncharted waters in every sense of the term, something that I have been saying for a very long time. The Federal Reserve, through off the charts currency creation, I would argue reckless currency creation, has created this artificial economy. And now it seems the proverbial rooster is starting to come home to roost. So more than ever, it's essential to pick through the statistical noise in order to identify the true fundamentals at work. Now, this is a chart from the Federal Reserve. This is personal savings as a percent of disposable personal income. The chart starts in August of 2008 and it goes through April of 2022. You see that at the time the stimulus checks were being liberally distributed, personal savings rate went through the roof. Now, however, those savings have largely been spent, and the personal savings rate is lower than really at any time since the financial crisis. It was only lower in 2008, and that led to a significant economic collapse. So that's likely where I believe we are headed at this point. Stockman says, for our money, the investigation starts with the obvious truth that when you're drawing down your savings rate, you're spending more than you earn. And since November of 2020, that's exactly what's been happening. Households have been spending more than they earn, which is a trajectory that is completely non-sustainable. Household wages and salary compensation, and it refers to a chart that I'll show you in just a minute, is up by 14.8% in nominal terms. But personal consumption expenditures have risen 21% more. So nominally speaking, their households are making 14.8% more, but they're spending 21% more. That is a non-sustainable trend. And here's the chart. You notice that at the far left-hand side of the chart in 2020, you see that households were not going backward. They were making more than they were spending. Wages were more than keeping pace with inflation, but since 2021, since this massive currency creation has started to hit the economy in earnest, the trend has been expenditures have been rising much faster than income. But Stockman makes a really good point. He says that these nominal numbers don't even tell half the story. When you wring out the inflation, what you get is some pretty midget numbers. That is, real PCE has been growing at only a 2.56% annual rate since the February 2020 pre-COVID peak, $6 trillion of stimulus notwithstanding. The reason is not a mystery. Inflation-adjusted wage and salary incomes are up by only 2/3 that level at a 1.66% per annum rate. So to keep the spending going, households are breaking into their piggy banks and they're adding expenditures to their credit cards. So Stockman says, no, we don't think there's anything strong about household spending. What is actually strong is the rate at which inflation has been eating into real purchasing power. Thus, what last week's spending and income report also showed was that the headline PCE deflator continues to rise, posting a 6.27% on a year-over-year basis, the highest gain since January of 1982, when inflation was out of control. That year-over-year gain compares to the 4.44% rate posted last October and the 3.58% year-over-year rate recorded last April. So that is acceleration with a vengeance. Stockman says the PCE deflator first crossed the Fed's 2% inflation target in March of 2021, and it's essentially tripled since then. So inflation is out of control. Still, the more revealing trend in the April spending and income report was the continued decline of the government transfer payments rates. This is a really interesting perspective. After peaking at an $8 trillion annualized rate, which is mind-blowing when you think about it, transfer payments have come back to earth, posting at less than half that level, 3.83 trillion in April. So transfer payments are just payments that the government makes to citizens. Well, that has been cut in half since March of 2021. And he said the apparent normalization of transfer payments, getting back to a level that is more normal, although I would argue still not sustainable. He said this is not what it appears to be. In December of 2019, before the COVID and STIBI perturbances knocked the numbers into a cocked hat, annualized government transfer payments stood at 3.11 trillion. So they're still a lot higher. The gain during the 29 months since that time, since December of 2019, computes to a 9.31% annualized growth rate. Despite that, we have consumers digging deep into savings because even almost $4 trillion of free stuff is not enough to fund what needs to be funded. So that's what I have to talk about. This is obviously a recorded presentation. I'll be back again live next week. So if you have questions, please carry those ahead to next week. I had a commitment today. So again, we will be back live again next week. Thanks everybody for participating. Thanks for getting the word out about what we do here. And I'll be back again next week. Have a terrific week.